Last week we saw one of the largest moves in the stock market in over a year. So where do we go from here? That's what we want to be talking about today. We'll be taking a look at some of the risks that are out there with the economy, as well as portfolio changes. Then we're going to wrap up with a couple ideas for your overall wealth management and advanced planning. So those are what we're going to be covering. We have a lot to get to, and let's get started. That brings us to number one, economic and stock market risks. What a week it was last week. You see, we saw a huge change happen. We came into middle of the week really with respect to a sell-off that was occurring in the markets, followed by one of the largest increases that we've had in over a year. So what we're seeing is that there's a lot of volatility that's still out there. But when we take a look at the S&P 500, which really is a broad representation of a lot of the stock market, but it's only 500 companies that are in there. And that's what we call market cap weighted, meaning the companies that are larger actually gain more of a share of growing the S&P 500. And this is really dominated by the Magnificent Seven. So we've seen this with Nvidia, we've seen this with Google and Alphabet, we've seen it with Meta, we've seen it with Amazon, that they are and have been a very good place to be growing the overall stock market. But what we have not been seeing are the smaller companies, and these are the ones that are dominated in what we call the Russell 2000. Now these are ones that are smaller and may not have nearly the same dominance that the larger ones do, and they're not performing nearly as well. So you see, there's periods of time where this happens, where the market cap, where the larger companies actually perform a lot better because they're liquid and they can actually distort things a little bit more, and this distortion can become extreme. Now what this will do is lead the stock market to veer out of control, either to the upside or to the downside. And guess what? We right now are experiencing one of those times. Now, don't panic. This doesn't mean that the end is nigh. In fact, history right here has really shown that the markets can still climb higher even during such periods. But it really is important to really step back. And this is a funny law. We call it Stein's law. And it was just an author that really had come up with this, which is not really anything of noteworthiness, but what it just says is things can't go on forever. Which, I mean, there's some truth to that, but what we want to say here is that we need to keep an eye on perspectives and these distortions that are happening. And yes, it may be something that we are seeing a complete reversal starting to occur. And like I talked about in the last couple of weeks, that all of a sudden these large companies will start to come down. But what we also are seeing is that there's a very real possibility of what we call a melt up scenario. So whether we melt up or melt down, that's the question. And what we are looking at right now is that when we saw everything back in November, and we noticed it is becoming right now harder to find stocks that are going up. So the number of stocks that are making new highs are starting to dwindle, especially in the NASDAQ, which encompasses a lot of this technology that we have been looking at, because it is really that market cap weighted. So Microsoft and Apple and Nvidia are going to get a higher really cap weighting or relationship in the NASDAQ or the S&P 500 than what it would be for, say, the Russell 2000. So what we can see now is that when we take a look at all of this, it may just be that the smaller companies may actually start to outperform. And if that's the case, we have nothing to worry about, and we have a new way that we can actually be working with the investments, because there's going to be many other opportunities out there. Now, there's going to be some other things here as well, that if the reverse comes true, then we'll have to look out below. So that's where we're at right now. But like I said, it's not really something we need to be concerned about, just because of the fact there may be some very good opportunities to take place over the remaining portion of this year, especially when we're coming into a lead 2 scenario where we have growth in the stock market, growth in the economy, growth of inflation, and all of that is very positive. So we, right now, could be witnessing the starting of a very positive period in our economy. Section 2, portfolio changes. We have really talked a lot about changes of the economy and with respect to small companies versus large companies. But what we're witnessing right now is something we've been talking about over the last number of weeks. So we don't have any new elements that we're going to be adding to the portfolios. Instead, we're really going to be looking at what we already have done and some of the changes that we're making already. So that includes some of those small companies that we've been talking about. That includes some growth and some technology, especially on the small company side, that may play catch up a lot sooner than others. But we also have been looking at other places like India and Philippines and many other emerging markets that could be great places to be invested. So those are some of the things that we've already been looking at for the portfolios. But when we add in the fact that bonds are not as attractive place to be right now, especially long-term bonds, now we're rounding out the portfolio and saying we have the diversification, we have the areas that we're going to be avoiding, and we have the ones that we want to be invested in. And as we see more positive signs, especially in the smaller companies, I really do think that it's going to be tied to a good economy to come. So that's why we're saying we have no new portfolio changes, but it's a matter of implementing what we already have been talking about. And that leads us to number 3, wealth management and advanced planning. This is going to be a little different. Let's shift our time to one intriguing question. Is social media hurting the investing and wealth planning that you're doing? Now, we all spend hours each day on social media. Some of it you may not even know about, whether it's Facebook, whether it's Twitter, now X, or whether it's other forms like Instagram or many other different places. They all become a social media hub. But have you ever considered the impact that that could have not only on your mental health, but also on your financial health? Now, there have been a lot of studies that have been done that really show that excessive social media usage can lead to anxiety, depression, even a disturbance of your sleep patterns. But also what's coming out is that that can affect your psyche when it comes to your wealth. So it's easy to fall into some traps with social media. And what we want to do is just have a thought process. So we don't fear social media, but that we have a smarter way to navigate it. So what I want to do is just take a few strategies here to consider that you could implement into your own wealth plan. Now, first, when it comes to social media, we want to limit our usage and stick to just a short amount of time on them. And we can take breaks as needed to think critically about the information, especially when it comes to changes of where we should be invested. Then we want to cultivate an offline or a time that you don't actually go onto social media and focus on other elements. So this can be where your critical thinking comes into place. But keeping an eye for your friends, your family, and all of the other people who are really there for you is going to be helpful. And then we want to really take away the negativity that's there with the excessive usage. So by doing that and developing good habits, that alone can actually help to improve your overall wealth plan as we limit the negative ones that really are on there, and also add to the critical decision making that you're already doing. That alone can help to improve not only some of the areas of your wealth enhancement, wealth transfer, wealth protection, and even some of your wealth and tax mitigation strategies. So that's why we want to be talking about this, because it actually has a very good, potentially positive benefit in what you're doing. And that leads us to section 4, our second opinion service. This is a great opportunity for introductions of your family, your friends, your coworkers, even your co-owners, to have a second opinion and a stress test of their wealth plan. So what we do here is really take them through that discovery process. We take them through a lot of the different areas of the overall financial plan, and put together a comprehensive analysis of the gaps that exist. Then we will look at strategies on how to fill those gaps. Then out of that, they can come away with a better understanding of their overall wealth plan and ways they can help improve it. So that's what the Second Opinion service will do, and that's the ways that you can help your family, your friends, your coworkers, even some of your co-owners to help better their overall wealth plan. So with that, let us know if you have any questions. I'd be happy to not only set a time for them for a second opinion, but then make sure that you are taken care of with any questions as well. So with that, I want to thank you for your time today, and let us know if you have anything else that you want to discuss. Take care.